Most retail traders have a common problem. They enter the market too late. But why does this happen? It's not necessarily because they are wrong about the market direction. It's because they chase the price. When they see a big green candle, they panic and jump in, thinking they are missing the move. This is the definition of FOMO, fear of missing out. Professional traders do the exact opposite. They don't chase the market. They let the market come to them. Instead of buying at the top of a breakout, they stay patient and wait for pullbacks. They understand that a breakout is just the beginning of a story. To enter a high probability trade, you need a pullback, structure, and most importantly, confirmation. In this masterclass, I'm going to show you exactly how to trade pullbacks with structure, patience, and precision. We will cover the two most reliable pullback strategies in existence, the break and retest and the trendline bounce. I will also explain the liquidity sweep logic that the big institutions use to trap retail traders. Ready to stop chasing and start trading like a pro? Let's begin. Strategy has honed, the break and retest logic. Let's start with the first pullback strategy, the break and retest. This is a simple but incredibly powerful way to trade with clarity instead of emotion. Many traders see a price break, a support or resistance level, and they buy or sell immediately. This is a mistake because that breakout could be a trap designed to grab liquidity before reversing. By waiting for a retest, you are staying patient and allowing the price to return to that broken level to confirm it. This confirmation step is your filter. It helps you avoid those deadly false breakouts and gives you a much more structured and confident entry point. Think of it as the market giving you a second chance to enter at a better price. The psychology behind the scenes. Why does the price pull back? When price breaks above a major resistance, it's a sign that buyers are strong. However, markets never move in a straight line. As price rises, early buyers who entered near the bottom start taking profits. This profit-taking creates temporary selling pressure, causing the price to dip. Retailers see this dip and think the trend is over, but smart money sees this as an opportunity. They wait for the price to hit the previous resistance, which has now flipped into support. If that level holds and price shows rejection, it confirms that the bulls are back in control. This is the change of character we look for. Case study: XAU, USD, and the range breakout. Let's walk through the process step by step with a real example. Look at this XAU USD chart. First, we identify a clear key level where the price has reacted multiple times in the past. Strong levels matter. Weak levels tend to fail. Here, we have a clear support zone. Notice how the price eventually breaks below this level with a strong bearish candle. When the breakout happens, you do nothing. You don't chase the move. You wait. As the price pulls back toward the broken support, you observe how it behaves. Your goal is simple. Confirm that the previous support is now acting as new resistance. If price reaches the level and rejects it with clear price action like a bearish pin bar or a rejection wick, that is your confirmation. In a range-bound market, this is even more critical. In a range, price bounces back and forth between support and resistance with no clear trend. This is where most traders lose money by getting caught in liquidity sweeps. When price finally breaks out of the range, remember, the breakout is not the entry, the retest is. Wait for the market to respect the new boundary before putting your capital at risk. Strategy #2, the Trendline Bounce Masterclass. Now, let's move on to the second pullback strategy, the Trendline Bounce. A trendline is a simple but effective tool that helps you visualize the market direction. It is drawn by connecting swing highs or swing lows. Its purpose is not to predict where the price will go, but to provide a structural guide for where pullbacks are likely to end. To draw a valid trendline, you must follow these professional rules. Rule Hasson: a trendline needs confirmation. You need at least 2 clear touch points to draw the line. The more times the price reacts to the line, the more relevant and strong it becomes. But remember, more touches don't guarantee it will hold forever. A trendline is a tool, not a promise. Rule #2: markets are not perfect. Trends are rarely clean or smooth. Price might briefly break a trend line, then close back inside, or it might spike through it to grab liquidity. This doesn't mean the trend line is useless. It means you must read the price behavior around the zone, not just the line itself. Rule #3. Think in zones, not exact lines. Price will often react slightly before or slightly after touching your line. Focus on the reaction zone. Rule #4. Never force a trend line. If you have to move your line around or ignore major price swings just to make it fit, it doesn't belong on your chart. A forced trend line gives you false confidence and leads to bad trades. Draw it logically based on natural price structure, or don't draw it at all. Advanced Confluence. Gold analysis. Let's apply the trendline bounce strategy to a real-world scenario on XAU/USD. Gold. Using a 5-minute chart, the market is clearly trending higher, making higher highs and higher lows. We connect the swing lows to draw our trend line. We are waiting for a pullback. When gold pulls back to our line, we don't just buy. We look for multi-timeframe alignment. We zoom out to the 1-hour chart to see the bigger picture. On the 1-hour chart, we notice a liquidity sweep. Price briefly broke below a support area, then closed back above it. This tells us that higher timeframe buyers are active. This is our confluence. When the lower timeframe, min, and higher timeframe, 1H, align, you have a powerhouse setup. The execution. On the 5-minute chart, as price hits the trend line, we see a bullish engulfing candle. This is our entry signal. We place our stop loss slightly below the trend line or the recent swing low to avoid being stopped out by minor noise. Our take profit is set at the next key resistance level, aiming for a minimum 2-to-1 reward to risk ratio. As you can see, gold respected the trend line and the momentum resumed perfectly. Conclusion: the path to precision. Trading pullbacks is about mastery of patience. You are letting the impatient traders get trapped while you wait for the market to prove its next move to you. Whether it's a break and retest or a trendline bounce, the secret is the same. Wait for the retest, wait for the confirmation candle, and always check your higher time frames. These two strategies are powerful additions to any trading plan. But remember, they work best when structure, price action, and context are all aligned. You aren't guessing, you are reacting to clear market behavior. Keep practicing these setups on your charts until they become second nature. If you found this video helpful and you want to dive deeper into professional trading techniques, don't forget to like, subscribe, and hit the notification bell. I read every comment, so let me know what you want to see next. Thank you for watching, stay disciplined, and I will see you in the next lesson. Scalping isn't about taking more trades, it's about taking the right ones. If you're still losing money, this video will show you why. Let's meet. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. Scalping is a short-term trade that is expected to make a profit from the fact that the price changes rapidly. Therefore, the time frame that we will use will be from seconds to minutes. Most of the time frames that I choose to use will be 1-minute time frames and 5-minute time frames. Scalping will focus on speed, accuracy, and most importantly, risk control or set stop loss. The example will be like this. The graph is the base market before the first period. You will see that the graph does lower high all the way. When it reaches a point, the price goes back. The point that goes back, we will look for the market structure shift, or the price has gone up the latest. When the price changes, we can use price action to help enter the trade. When the price goes up for a while, we may have sold out. We look for a new entry point, a short trade. This kind of trade is suitable for a market that is competitive. If you want to buy, you can buy. If you want to sell, you can sell, or what we call high liquidity market. Today, I have a trading technique that I have tested 4 types to share with you. The first type is called previous day false breakout. The first step is to look at the graph. The line that you see now is the day. The distance between one line and another is 1 day. Therefore, I call the left day as yesterday and the right day as today. This technique, we will use the information from yesterday to enter the trade today. The information used yesterday, we will look at the highest price and the lowest price. So I call it previous day high and previous day low. In these two lines, most traders will see it as a positive and negative trend. Therefore, if the price bounces or bounces out, it will be a very good entry point for trading. Next, when we get high and low, we will start to look at the market today. When the price opens, there is a chance that it will go up or go down. In this example, the price goes up. Therefore, I will continue to draw this line. When the price goes up, we have 2 to 3 choices. The first choice, we can trade breakout, or the second way, wait for it to pull back and bounce up. But for this case, we will not trade breakout. We will wait for the price to rise and turn into a false breakout, and we will wait for the price to go back down. At this point, the main part of smart money is the liquidity sweep. The big line pushes the price up and pulls it back down. Therefore, we will wait for the trade to follow the big line. When the big line pulls the price down, we can open the shot and the price will have a chance to go down for a long time. Let's take a look at the example. The first example, you will see the line. Left hand is yesterday, right hand is today. Yesterday, there was a high point around here. It fell out. Friends will not see it, but I will draw a line for you. When we start today, we will keep looking at it. After a while, the price breaks out, has a pullback, and goes up. If you enter this trade and exit quickly, you may get one profit. But for this policy, we will wait for the fall breakout. When the fall breakout occurs, the price will go back. We will not trade breakout and we will not trade pullback. We will wait for the price to go back and become a reversal. After the liquidity sweep, we can open the shot and the price has a chance to go down. Let's take a look at the example. The first example, you will see the line. Left hand is yesterday, right hand is today. Yesterday, there was a high point around here. It fell out. Friends will not see it, but I will draw a line for you. When we start today, we will keep looking at it. After a while, the price breaks out, has a pullback, and goes up. If you enter this trade and exit quickly, you may get one profit. But for this policy, we will wait for the fall breakout. When the fall breakout occurs, the price will go back. We will not trade breakout and we will not trade pullback. We will wait for the price to go back and become a reversal. After the liquidity sweep, we can open the shot and the price has a chance to go down. Friends can close the shot as quickly as possible and get full profits. At this point, you can use other indicators to build a trade. The indicator that I recommend is to look at the volume. When the price breaks out and it goes back, the volume should be very high. This indicates that the market is ready to go down. When we look at the volume is a lot. We can open the shot comfortably. The third example for the first example, as usual, we have yesterday and today. Yesterday, there was a low point at the bottom. When it opens today, the price is still for a while. Finally, the price decides to go down. When it goes down, we wait for a liquidity sweep or a fall breakout. After the sweep, we wait for the price action signal. In this place, it is very clear. You will see a bullish engulfing. Or even better, it is a 3-line strike. The price goes down because of the 3 chains attached, but there are 4 chains that engulf or swallow all the chains before the face. Therefore, the market has risen to the full. You can buy in and the price will go up for a long time. The next example, it's still the same idea as yesterday and today. Yesterday, this point was the low point. Therefore, there will be a previous day low around here. When the price opens today, it seems to go up a little bit, but it went back down, the test that has been accepted many times. Finally, the big line pushed the price to hit the Yoi's stop loss. When the price is pushed down, all the graph liquidity is a fall breakout. Finally, he pushed the price back into the same range. We can buy according to the big picture. The second, third, and fourth strategies will be all pullback trading, but there will be a point of reference and different trading methods. The first method I named first pullback. The principle will be like this. The price goes down first, doing a lower high and a lower low. When it reaches a point where there's a market structure shift, the price goes down and becomes a rise. When the price falls here, we will not enter the trade yet. We will wait for the price to go up and then move back. When it comes back, we will only be interested in coming back for the first time. So I call it the first pullback. When it goes up for the first time, we look at the price action to enter the trade. And when we enter the trade, it seems to be the beginning of the trend. The price has a chance to go up after we buy. Let's look at the example of the first pullback. On the left-hand side, you will see that the price is falling. The price has been making a lower high all the way to the point where the price has fallen the most recently. There is a market structure shift. We don't trade breakout. We will wait for the price to make a first pullback and then come back to the original trend, which has now turned into a trend. When the price goes up again, we will look for a suitable price action to enter the trade. There are many ways to change the time frame. Look at the chart pattern. Look at the skyline graph. After watching and being confident, you can buy. After buying, the price has a chance to go up for a long time. Another example is still the same. The left hand is a long down market. The price made a beautiful lower high until it reached a point where the price went up. At this point, the market structure shifts. We will wait a while. When the pullback price comes back, we will find the time to enter the trade as before. This gold bar is a hammer. I can say that there is a lot of buying power, but due to the fact that the graph is not yet confirmed, we will wait for a while. When the price is small in the first pullback, we see bullish engulfing along with a long trend. Therefore, we can trade in this area or wait for the price to hit this high. After buying, the price rises rapidly. The third example of the first pullback. The market will rise and fall. The left hand is the market to rise, do higher high, and do higher low. We will wait for the price to come back. The latest high, which is in this area. At this point, there is a market structure shift. The price has a chance to go down, but we will wait a while. Wait for the first pullback. There was an increase in the first time, which in this area, it also increased to this area. In this zone, we can find the time to open the shot. After opening the shot, the price will have a chance to go down for a long time. From this example, I'm sure. Wait for the price to hit this area first and then open the shot. But some friends may zoom into this area and open the shot faster than this. The last example for the second factor is the uptrend market, going back down. The price made a higher high and a higher low as before. When the price can't break high, there is a recent low return, it becomes a market structure shift. At this point, we don't trade breakouts. If you trade breakouts, you may get profit. But in this case, we will wait for the first pullback. Wait for the price to come back, adjust. After adjusting to be sure, the price has a chance to go down, back to the bottom. We can open the shot. This pair is bearish and carving. The price has a chance to go down. The third technique is the pullback trade that I like the most. That is VWAP bonds. If you follow this channel from the beginning, you will understand how much I like this indicator. VWAP comes from volume weight average price. Mainly, it is a ratio that takes the amount of buying and selling into account. Similar to EMA, but better, because there is a volume come in and weigh it. The way to look at it starts from these two lines on the left hand, which is a new day, and the right hand is the end of the day. Therefore, from left to right, it is one day. The blue line is the V warp line. When the day is over, it will reset and start a new calculation at the beginning. Friends may wonder that, why does this line suddenly rise strongly? Actually, it doesn't rise. When it runs out and starts again from the top. The basic view of VWAP, we will look at it like this. I would like to divide the graph into two parts. On the left-hand side, the price will be below VWAP mostly. When the price is below VWAP, it is said that it is a down market. But when the price of VWAP is up, now the price is on the top. When the price is on the top, it is said that it is a down market. The VWARP trade method that I like to use will be like this. But for today, I will only pull one indicator. That is, pull back to VWARP and bounce up. The principle is that we will wait for the price to run away from VWARP first. After that, there will be a return. When the return comes back, the test at VWARP, we will find an easy time to enter the trade. Look ahead for a while, the price will go back to the test at VWARP again. After the test, we will find a new time to enter the trade. And the price action that I use to confirm the easiest is bullish engulfing. When we meet this pair of gold bars, the green one is closed, eating the red gold bar. You can check it out. The left hand is bullish engulfing. We can buy when the bar is over. When the price goes up, we will close the scalping trade and get full profit. The price goes back again. Bullish engulfing occurs again. We can buy, and the price goes up to profit again. The next example, the idea is the same. The price went up in the first period. After that, try to escape from VWAP. Wait for the price to come back to test at VWAP. After the test, look at the price action. Grab this pair. In this case, in addition to bullish engulfing, it's also a free line strike. So when the price is over, we can buy, and the price has a chance to go up for a long time. The next example is the market going up and going down. At first, the price went up first. After that, there was a return to VWAP. At this point, the mouse area that I pointed out, basically, we will wait for the price to test and then go up, right? But in this place, the price is falling. There is no bullish engulfing. Therefore, we let the price fall further. When it falls, we will have to change the perspective. From trading up, now it will become a trading down. And when the price goes back, this area is a test of the resistance. It is a test of VWAP itself. Therefore, we will look for a chart pattern that can be used to confirm entering the trade. And of course, it will be a chart pattern that is bearish engulfing. When we find bearish engulfing, the price has a chance to continue through the game. We can open the shot, and the price also has a chance to continue for a long time. Scalping trade is a fast trade that can go out quickly when the reward-risk ratio reaches the target we want. The last example of VWARP is complete. Left hand is a rising market. There is a rise to test at VWARP. After the test, look for bullish engulfing. Immediately found. Considered to pass the gain. After passing the gain, we can buy it. After buying, we sell it on the top, and we wait for the price to rise again. But this time the price rose back down. Therefore, we will not buy this trade, because there is no confirmation that the price will bounce up. When the price goes down, we look at the stock market instead, and the price went back to the test at VWAP. After the test, no more power. Can't go on anymore. Turned into bearish engulfing. We can open the shot, and the price has a chance to go down for a long time. The last advantage for trade scalping that I tested and got good results, that is pullback to fair value gap. Fair value gap. If you were in the smart money concept line, you will know fair value gap very well. But for those of you who are not in the SMC line, I have a short review for you. FVG, or fair value gap, is when the price rises or drops rapidly. There is an empty space of price. In this area, when the price moves too fast, the price you see may not be the price it should be. For example, there is a price shift, or it may be good news or bad news, causing the price to rise due to panic. It looks like this. There are 3 bars. The first bar is still normal. When you find the second bar, the price rises rapidly, creating a fair value gap. At this point, we will measure from the high point of the first candle to the low point of the third candle. And in the middle, it is a fair value gap that the price rises rapidly in the second candle. The price goes down, it's the same. It's a candle that goes down first. After that, there was a severe price drop, which turned into a fair value gap. When we find a fair value gap, we will use this principle. The market will try to adjust itself to bring the price back to the price it should be, which we call this price the price that is done or the price that is correct. Fair value price. Therefore, the way to enter the trade is not difficult. We look for a market that is up first. There is a fair value gap around here, and we know that the price has a chance to come back. Adjust to the price that is done. When the price is adjusted, we can buy. and hope that the price will go up for a long time. There are many ways to buy. You can buy it from the first time the price hit or buy it in the middle of FVG. If you are experienced, you may zoom in, change the time frame to be more detailed, find a better time to enter the trade. Let's take a look at the example. This example, you will see that the price is high. When the price goes up, at one point the price rose rapidly. In this area, a fair value gap occurred. Measure from the first to the third bar. When we get FVG, we just wait. Wait for the price to come back to FVG. When it hits, we can buy, and the price has a chance to go back up. The next example. The left-hand side looks like a sideways market, but if you look at it in detail, it will be a chart pattern that has momentum build up. This chart pattern is the ascending triangle. The price tried to go high many times, but couldn't. At the same time, the price began to accumulate power by raising the low. Therefore, the price has a chance to break out and go up for a long time. In this place, the price breaks out and rises rapidly. We will get FVG around here. Wait for the price to come back. Wait a while. The price will adjust to the price that should be. We can buy, and because of the momentum from the beginning, it's been up all the time. So when you buy it, you can be sure that the price will go up for a long time. The third example is to go back down. The left hand is a sideways market. It's a consolidation. The price won't go down. It won't go up. It won't go up. Until one point, the sales side is the winner. The seller pushed the price down heavily. We can find FVG. After we get the fair value, we wait for a while. Wait for the price to come back and touch the FVG. After touching, we open the shot, and the price has a chance to fall far away. The last example is the market. There are 2 points of FVG. If you can block the time, you will get both profits. The first step, you will see that this area is a low point. It's a low over low, and in the meantime, there was a sharp rise in price. In this area, we got a fair value gap. Wait a while. The price will come back to the fair value gap. We can open the shot. Open, and the price goes down. Get a full profit of 1. And when it came down, the price went down again. The latest low turned into a lower low. In this area, we can find a fair value gap. And finally, the price went back to this fair value gap. When the price closes the gap, the price enters the balance. It will choose the side. In this place, we open the waiting spot. Because the market has been down for a long time, I hope the price will go down. Finally, the price really went down and got the second profit. All of this is the scalping trade that I have tested. There are 4 methods that have the best results, and I like them the most. The first formula is the fall breakout. The other 3 formulas are all pullback trades. Friends, you can try to test to see which currency is suitable for the asset that you are using. And how do you get the result? You can tell me in the comments. See you in the next clip. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. If you're still losing money trading order blocks, it's probably because you've been taught the wrong way. Today, we're breaking down what order blocks really mean. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Order block is the price zone that the price likes to move back to this zone. For example, in this graph, the price rises first, then rises again. Every time it rises and goes up, if the price goes up, we will call it a breakoff structure. This is the point where we can find the order block, and the price has the opportunity to come back to hit the order block and go up. After a while, the price goes up again, and a breakoff structure occurs again. Therefore, you will get a new order block, and this order block will do its job as a price zone. Wait until the price comes back to the zone. When it hits, the price will have a chance to rise again. You can see that the order block is an important zone. Therefore, today I will take you to hunt for the best order block. If we find an order block, these order blocks have a lot of opportunities to make a lot of profit. For those of you who have just opened YouTube and come to this channel, you still don't know what order block is. So, let's learn about order blocks together today. The first one is called engulfing order block. The second one is hesitate order block. It is a block of hesitation. The third one is impulse order block. The price of this order block will rise to be a large green bar. Many bars are attached. And the last one is pause order block. It's an order block that prices rise, there's a little bit of hesitation, and then it goes up. This time, not every order block will be able to be used effectively. Today, I have 4 gains for you to check. What are the 4 gains? Let's take a look. The first gain is that a good order block should have a break-off structure. When a large group collects goods within the order block, it will raise the price to the same high. At this point, a break-off structure will occur. The second gain is that a good order block should have a gap or a fair value gap. The third gain is that an order block should be unmitigated. That is, this order block should no longer be used. If the order block is used, it will be considered that it is not profitable. And finally, a good order block should have a liquidity sweep around the order block. I will take you to look at each gain, and in the end, I will include all 4 gains together, and let's check to see which order block has 4 gains or not 4 gains. The first gain is break-off structure. The example is as follows. The price came up first. There will be an uptrend and continue to rise. The area where it continues to rise, it will cause a break-off structure. When the break-off structure occurs, there will be an imbalance. If we go back, we will get an order block. This order block is considered to pass the gain because it is an order block that causes a break-off structure. In a while, the price will go back and continue to rise. The price will go up again, causing a break-off structure again. In this area, it is set to be a trend imbalance. Looking back, you will see a period when the price is hesitating. In this area, it is set to be a post-order block and an order block that passes the gain because it causes a break-off structure. Finally, there is a break-off structure that occurs again. This order block will be an order block that passes the gain. A trend imbalance occurs, an order block occurs, and the price goes up. The next example will be the market falling. The price came down first, there was a drop, and then it went down. When it went down, it made a new low. There was a break-off structure, there was a tankade imbalance. If we go back, we will get an order block. This order block goes through the first gain because it is the initial order block that causes a break-off structure. In a while, the price will go up and go down again. There will be a break-off structure again. This large red bar is called an imbalance bar. There is an order block in this area. This order block also passes the gain because it causes a break-off structure at the bottom. Next, the second gain is the gap and the fair value gap. There are examples to see both the usable and the unusable. On the left-hand side, you will see an order block. When the order block occurs, there is an imbalance. This area is a fair value gap or a price gap. The price has dropped and risen sharply. Therefore, the price has a chance to move back to the price that is done. We call this point a fair value gap. Therefore, this order block, it is considered to be an effective order block. On the other hand, on the right-hand side, we will also get an order block because there is an imbalance. But if you look at it, the price is not very high. The price has risen, but it has already returned. Therefore, our gap will be very narrow. When it is too narrow, we will consider that this order block is not effective. Let's take a look at the real example. The first example is on the left-hand side. The price goes up and there is a break-off structure. We will get an order block coming up from the bottom. The next step after the order block, we will get a fair value gap. Therefore, this order block through the gain is effective. After a while, the price goes up and goes up again. When it goes up, we haven't done anything yet. Wait for a while, the price will break off structure again. We look back, we will get a post-order block. This order block also creates a fair value gap. When the price rises sharply, it becomes an empty space of the price. We consider that the previous order block was effective. But if we look back on the left-hand side, this area is also a post-order block. The price has risen dramatically, but we don't see a fair value gap. Or the fair value gap is too small. We will set it to be an unprofitable order block. Why? Because the price is just a moment. Woke back and broke the order block. When there is no fair value gap, the price has a chance to break the order block. go find a better order block. Another example, it's still a market. The price has risen and continued to rise. At this point, a break-off structure occurs. We got an order block. In this area, there is a large space of price. There is a fair value gap. Therefore, this order block passed the second gain. Not long ago, the price rose back and continued to rise. In this area, a break-off structure occurred. If we look back, there will be two large order blocks. One on the top is a post-order block, and the other one on the bottom is a normal order block. This order block is set to be an effective order block because when an order block occurs, the price will rise and create a gap. Therefore, this one is considered to pass the gain. The one on the top, if it looks good, it will pass the gain as well. But I didn't draw it up for you to see. You can try drawing it and check it out. You will see the fair value gap and consider this order block through the same gain. The third gain is called unmitigate. A good order block must not be used. For example, the graph on the left-hand side. The price is rising and rising. We got an order block. After that, there is a space of price. Notice that the price did not return. When the price doesn't go back, it won't hit the order block. That means that this order block is not yet in use. Can be used in the future. But on the right-hand side, when we get the order block, notice that the price is moving. But in the next bar, the price has gone back. When the price hits this order block, we will consider that this order block have been used or mitigated. Therefore, in the future, this order block will not be effective. The price will have a chance to come back and continue to fall. Let's look at the real example. This example is a market that has risen before. There was a growth and then it went up. When it went up, there was a break-off structure, a trend imbalance, and then an order block came up. But if you look closely, there will be a bar that drops down. When it drops down to the order block, we will consider that this order block has been mitigated or used. When it is used, when the price goes up and goes back, there is a chance that the price will not be interested in this order block. For example, around here, the price acts like it will go up, but it can't go up far. It will go down again. If it goes up again, it won't go up again. In the end, this order block can't be accepted anymore. The price went down the order block and went down for a long time. The price went down the order block and went down for a long time. Another example is that the market has risen. There was a new break-off structure. When the first break-off structure was created, we got an order block. This order block creates a fair value gap, and notice that the price did not work back at this order block. Therefore, this order block is unmitigated. The price has a chance to come back in the near future and go up. Another point, we also get an order block after it breaks off structure. This order block is not yet used. Tengtian has already gone. It hasn't moved back yet. We consider it to be unmitigated and can continue to use. The last gain is liquidity sweep. A good order block should sweep the liquidity of Tengtian in advance. For example, on the left-hand side, we have an order block, which is around here. This order block is long. That means Tengtian in advance. If there is liquidity, it will be washed away already. I would like to specify two bars to compare. The first bar is considered to be the first bar. The second bar is the order block. The lowest low point of the first bar is around here. Investors who buy at the end of the first bar will set a stop loss at the bottom. But when the second bar occurs, the price is less than all the liquidity of the first bar. This kind of thing, we call it a liquidity sweep, set to be an order block that is effective. But on the right-hand side, it will be an order block that cannot be used. The order block will be in this bar. There is the first bar and the second bar as before. The first bar has a very long range. That means there is a lot of purchasing power. And there will be liquidity left at the end of the first bar. When we draw the order block at the second bar, when the price goes back, what happens? The price has not yet been sweep liquidity. The price will continue to go down, continue to sweep all the liquidity of the first bar. That means that if we use the second bar to build an order block, our stop loss will be under the order block and have a chance to be pushed down by a big line to collect liquidity of the first gold bar. Therefore, in this situation, it is considered that our order block is not profitable. Let's take a look at the real example. This example is still a falling market. There is a rise and then a rise for a period of time. On the left-hand side, there is an order block. If you look at the gold bar before, you will see that the low point is around here. Our TNT order block has exceeded all liquidity. Therefore, we can continue to use it through the gain. After a while, the price rises, hits the order block, and continues to rise. When the price rises again, there is a break-off structure again. We can build a new order block. But this order block is not very safe, because the previous 2 to 3 TNT blocks had quite a long size. And this block has a long chain that is not enough to sweep the liquidity of the previous block. Therefore, this chain will be very risky in building an order block. The price has a chance to go back through the order block to the rest of the liquidity before it goes up. Therefore, the stop loss that occurs from this order block will be considered very risky. Another example is the rising market, but there is a deep increase. When it increases a lot, there is an order block. This order block is considered not to pass the gain. Due to the previous trend, there is a longer interval, still not able to liquidity sweep. We can't use this order block. For a while, the example is in this area. This area is another order block. Due to the price, there is an imbalance trend and a breakoff structure, but this order block is expected to be profitable. Because of the previous 2 to 3 tiers, it's all more than liquidity. The lowest tier is around here. It's already been liquidated, considered to pass the gain. Okay, to this point, you all know the 4 gains of the order block that are profitable. I'll take you to look at 3 to 4 examples, and let's see how many gains each order block has. If you pass all of them, it's considered to be very profitable. If you pass some, like 3 or 2, you have to decide whether to use that order block or not. Let's take a look. The first example is a rising market. In this area, there's a big imbalance. There's a breakoff structure. If we look back, we will get an order block. This order block goes through many gains. There is also a fair value gap. Moreover, the price is not returned. Therefore, we will have a breakoff structure, a fair value gap, and the order block is not yet used. After 3 gains, let's check the last gain, which is around this low point. You will see that the chain that created the order block has exceeded all liquidity. Therefore, this chain will go through the gain liquidity sweep. In conclusion, this order block is very effective through all 4 games. Next, when the price rises, there is an increase and a new rise. At this point, there is a breakoff structure. Looking back, we will get an order block. But if we look closely, this order block will not have a fair value gap. And most importantly, the price has returned to the order block. Now we only have a breakoff structure. But we don't have a fair value gap and we're already used to it. Finally, if we check liquidity, this area is a low point. Our order block tag has been priced down. Therefore, the liquidity sweep has been done. It turns out that this order block has 2 gains and 2 losses. For me, I can't use it. The next example is still a market that has risen. The price rose before there was a rise and then rose again. The point where it rose again was the breakoff structure. If you look back, you will find that there is an order block. But this order block looks bad. Looking around, there is no fair value gap, and the price has returned to the order block. Therefore, what we have is just a breakoff structure. There is no fair value gap. It has been used for a long time. Therefore, it is not very effective. The last check gain is looking back at the low point. Before, the low point was around here. Now, it has gone down to liquidity. Therefore, this order block will pass the 4th gain. But because it passes only 2 out of 4, I will let it not pass the gain itself. After a while, the price goes up and rises again. After the rise, it goes back up and there is a breakoff structure. If we look back, we will get this bar as an order block bar. At this point, if you check it, there is a breakoff structure. There is a fair value gap. The price did not go back to the order block. Therefore, after the gain, there are 3 points. The 4th point is very easy to see. The low point is around here. Therefore, the longer the liquidity, it is considered that the other gain becomes a complete order block. The price has a chance to roll back, hit the order block, and bounce up. The 3rd example is the last example of the rise of the price. The price rose and continued to break off structure. Looking back, we will get an order block. We check the fair value gap first. After that, we check mitigation. The price did not mitigate this order block at all. Therefore, it went through 3 gains. But if we check the last gain, we will find that the previous candle has a very long candle. Therefore, this candle that created an order block, there's still a little bit of liquidity left. We will consider that it is not yet past the gain. It is not yet past the gain. And what to do? Is there a way to fix it? Yes, it's very easy. We move to 1 bar. For example, our order block is at this green bar. Now, if we move back 1 bar and we build this bar to become an order block, at this point, if we check again, we will see that there is a gap in the fair value, and this order block is not yet mitigated. Therefore, now we have 3 gains. The 4th gain, because we have moved, the lowest low point is around here. The current trend is higher than liquidity until it runs out of max. Therefore, now we will consider that this order block has sweep liquidity and passed the gain. This method can be used as an example. In the past, it did not pass the gain. Try to move to the left or right to see it may pass the gain. And the order block that occurs from this move becomes an order block that is positive instead. The last example will be the fall. The price goes down first, there is an increase, and then it goes down. The point that it goes down, there will be a break-off structure. If we look back, we will get an order block. This order block creates a fair value gap at the bottom, and there is no price to touch back. Therefore, through all 3 gains, the last gain. If we look at the high price, we will see that this price that creates an order block is better than all liquidity. Therefore, we consider it to be through the gain. Liquidity is sweep through the gain. It is considered to be an effective order block. On the other hand, if you look a little further, when the price goes down, there is a drop and a new drop. At this point, the price breaks off structure in the trend. The price falls to the low point. In this area, if we look back, we will create an order block. But this order block is not profitable. Through the gain break-off structure is true, but the fair value gap is small. It is not through the gain. And if you look at it, even though it will not be used, but it has a disadvantage because it has a long chain. This chain will have liquidity waiting on the top. This order block is not better than all liquidity. Therefore, it will not pass in the last gain. The way to fix it is not difficult. The first one, we don't care about this order block. Or friends choose to draw a new order block. The way to look back around here, if we look at the whole zone, it looks like a base or a base. At first, the price had a rally. I found a big base. After that, there was a drop. In the base area, we can draw a new order block to make it wider than before. For this order block, you can check the gain per gain. First, there is a break-off structure. Second, there is a fair value gap. Third, the price did not go back at all. In this zone, the price has gone and accepted. And finally, in the previous area, there is no liquidity left. Between this one and this one, more than liquidity. Therefore, this order block can be used through all 4 gains in the future. The price has a chance to bounce back, hit this order block, and bounce back. All of these are the 4 gains that you can use to check the order block. The most effective or the best order block should have all 4 gains. If it's done, you can buy it or wait for it. When the price goes back, there is a chance to bounce and go on. See you in the next clip with other smart money concepts. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. If you're still losing trades after learning candlestick patterns, you're studying them the wrong way. Candles aren't just shapes, they tell the story of the battle between buyers and sellers. In this video, I'll show you how to read that story like a professional trade. The first reading of the candlestick chart is one of our 4 episodes. The first episode is about the meaning of the candlestick chart. What is it, and what does each column tell us? If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. The second episode is about reading the candlestick chart without remembering, and the third and the fourth will be different types of graph, which will follow in the next clip. Let's get started. What is a graph? A graph is a type of graph. It has the shape of a scale. The scale consists of the part that is the scale, which is the part that is thick. And there will be a scale, up and down, both top and bottom. The scale is called the body. We call it wick. Now, there are many types of wick, right? It will be like this, with a little wick and a long wick. Or there will be a lot of wick and only a little wick on one side. In some cases, there may not be any wick, but there is almost only one wick. This wick graph will tell you the opening price of the day, the closing price of the day, the highest price, and the lowest price, all in one. What's more important is that we can tell the investment action, what the buyer wants to do, what the seller wants to do, and we can also predict the trend of the market in the future. Let me give you an example. The gold bar in the market has risen. The market opened in the morning at the price of $9, and the closed market in the evening at the price of $13. You will see that today the market is rising, starting at $9 and ending at $13. Now, if we drag the line from the opening price and then drag the line to the closing price, we will create a trend. The trend is to open and close. Now, when it opens at a low price and closes at a high price, so there will be a green color instead of the price. Now, the main filling. The filling is the lowest price and the highest price. The lowest price is $8, which is the filling at the bottom, called low. As for the highest price of the day, or high, it will be the filling on the top. Look at another example. The price opens at $11, and the closing price is $12, which is very close. Therefore, the size of the diamond is short, because the opening and closing are close. Open $11 and close $12, but the lowest price and the highest price are quite different. The lowest price is down to $8. It will be a long diamond inside. Down below is the low side. The highest price is $13. It's not very long, but it's short at the top. Now let's look at the example of the lower leg. The lower leg will go back, that is, open high and close low. Open high when opening, open at 13, and when closing, close at 10. Now we will create a diamond, or the diamond rod will open and close. But because it opens at the top and closes at the bottom, so we use the symbol as a color, which is red. On the other hand, the market has a downturn. As for the inside, the top and bottom are the same. The bottom will be the lowest price of that day, and the inside at the top will be the highest price of that day. Now, to sum up a little bit, the uptrend will be green. The open price will be at the bottom, and the closing price will be at the top. This indicates that that day the stock rose. And if it is a lower leg, it will be red. Open at the top, open high, and close at the bottom, which is at the bottom. Now it will have a cool name. The upper leg is called bullish candle. Blue or bullish candle is what we like to call it. As for the lower leg, it'll be called bearish or bear. I would like to take you all to see the real thing. The example you see here is from the TradingView program. One bar represents the price of one day. Therefore, in each graph, the left and right sides will represent the period of about 1 month. But we can see that the left and right sides of the graph are not the same. On the left side, the graph is quite consistent. It will be continuous. On the right side, you will see that there is a jump. It looks like it will be missing and not continuous. Why is that? Because the example I brought is from two different markets. On the left-hand side is the cryptocurrency market. This market opens 24 hours, which means that the end of the day will be a new day immediately. Therefore, prices continue to fluctuate. According to the time of Thailand, the new stock will start at 7 a.m. Therefore, suppose this stock starts at 7 a.m. and then at 6:59 a.m. of the next day, the stock will end. And then at 7 a.m., the new stock will continue to rise. On the right side is the stock market. The stock market will have time to open as usual, that is, open in the morning and close in the evening, which will depend on the market of that country. How many hours will they open and close? The new trend will start when the market opens, and when the market closes, there may be several hours of time, which is at night. Nothing happens. There is no buying and selling. But the economy continues to progress. Therefore, when it rises, it may have an opening that can jump. Let me take you to see an example, like zoom in. Crypto market. Suppose the bottom is the 1st, 2nd, 3rd, and 12th days. For example, the 2nd day. The 2nd day closes the market at the price at the white line. It will open the new market on the third day immediately because there is no time to stop. Look at the next example of the sixth day. The sixth day, the market is closed at the top, the market rises. Open the new day on the seventh day, it is in the same price. The 11th is the same. Close the market at the top and open the market at the 12th in the same price. The Forex market, if we look at the example here, the 6th and the 7th. The 6th is closed at the top, but what happened? There was a price jump, right? On the 7th, the price jumped. Why is that? This is not difficult to explain. That is, in the evening, the market is closed. But there may be good news. For example, the company said that the results this year are very good. There is news. Therefore, people think that the stock must go up. The price must go up. When the new day opens, people will sell at a higher price. Probably no one wants to sell at a low price because the news is good, right? Now people buy. If they want to buy, they have to pay more to get this Forex. On the other hand, let's look at the 9th and 10th. On the 9th, the price closed the market very well, but I don't know what happened that night. There may be rumors that some countries do not accept this kind of product anymore. If they don't accept it, they can't sell it to that country, so the price fell. When the market opened the next day, the price fell because people knew the news at night. Therefore, the Forex market will be different from crypto here. Crypto will continue. As for the Forex market, there will be a period when we can't do anything. Just sit and watch and expect what will happen on the day it goes up. Now, if we look at a lot of images, we will see that there are many types of candlestick graphs. Some of them are here. There is no candlestick, and there is a long candlestick. Some have a lot of candlestick. There are only a little bit of honey. Some of them have a little bit of honey, but the filling is very long. And some of them, on the right side, there is no honey. There is only honey. And there is only honey on the bottom. There is no honey on the top. Each one has its own meaning. If we can explain the meaning of each one, we will understand the market better. What does each sugarcane tell us? Let's take a look. Let me give you an example of this bar. This bar is a rising market. It opens at the bottom and closes at the top. That is, there is a trend going up all day. Let me give you an example of a graph. It opens at the yellow point and rises a little bit. But in general, the trend is rising and will end the day at the top. This kind of graph will be seen a lot. We call it a bullish candle. That is, there is more demand than supply. There are people who want to buy more than people who want to sell. When there are people who want to buy a lot, they have to fight to buy. And ask what to do if you want that product. You have to offer a higher price, right? It's limited, but we want to get it and we have to compete. We have to pay at the end. When we pay at a higher price, the price will go up. This is the market going up. Another one will be the opposite. It's a market going down. Open at the top price and close at the lower price. Now we call it bearish candle, which means there is less demand than supply. There are fewer people who want to buy, but there are more people who want to sell. So if everyone wants to sell but can't sell, what should we do? We have to cut the price, right? We have to compete to reduce the price. Therefore, those who sell later have to sell at a reasonable price. But if you want to sell, you have to accept to reduce the price. Therefore, the overall price of the market will drop. Now these two are quite easy because we will see each other often. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. The lure of the moving average. In this video, we are going to reveal the absolute best strategy that you can implement right now using the moving average indicator. Moving averages are undoubtedly the most famous technical indicators in the entire trading world. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Almost every beginner starts their journey here, attracted by the clean, smooth lines that seem to make market trends incredibly easy to read. But despite their popularity, the harsh reality is that most traders are actually using them the wrong way. The core strategy we are discussing today is known as the moving average crossover. It is a very simple and historically famous trend-following strategy. In theory, it is beautiful. When a faster moving average crosses above a slower moving average, it signals an uptrend, and you buy. When the faster average crosses below the slower one, it signals a downtrend, and you sell. It sounds incredibly easy, yet this is the exact trap where most retail traders end up losing their entire accounts. Part 1. The 2 biggest crossover mistakes. Let's analyze the biggest mistakes that traders make when executing this strategy. Mistake number 1. Instant execution on crossover. The moment the lines cross, retail traders immediately open a buy or sell position. They think the crossover is a magic trigger. However, this only works when the market is in a strong, sustained trend. In a trending market, crossovers can catch massive moves, but markets only trend about 30% of the time. 70% of the time, the market is in a range-bound, sideways phase. In a range, price bounces back and forth between support and resistance. Because moving averages are lagging indicators, meaning they calculate past price data, they will flatten out and cross over each other repeatedly inside a range. If you buy and sell every single crossover in a ranging market, you will get hit by dozens of false signals in a row, which will wipe out your account incredibly fast. Mistake number 2. Using too many moving averages. Many traders believe that if 2 moving averages are good, then 5 or 6 must be better. They load their charts with a 10, 20, 50, 100, and 200 period average. They wait for all of them to cross over and align before entering a trade. This is a massive mathematical mistake. Every single moving average you add to your chart increases the total lag of your trading system. Let me show you what I mean. Let's say you're using a simple system with just 2 moving averages, the 2-0 period and the 5-0 period. When the 20 crosses above the 50, you get a buy signal. Now, look at what happens if you add a third, slower moving average like the 2-0-0 period. If you wait for the 20 and 50 to also cross above the 2-0-0 period average before you buy, your entry signal is delayed significantly. By the time all 3 averages align, the trend is often already exhausted, and you end up buying right at the top. The lesser the averages, the better the signal. Part 2. The correct way, higher time frames and historical reaction. Now, let's discuss the 3rd major mistake, trading on lower time frames. Lower time frames, like the 5-minute or 1-minute charts, are filled with market noise. These time frames have very short-lived trends and are dominated by range-bound conditions. If you try to trade crossovers on lower time frames, you are guaranteed to fail. Instead, you must trade on high time frames. We highly recommend the daily time frame, or at a minimum, the 1-hour time frame. So, how do we trade the crossover the correct way? First, we only use 2 moving averages, the 2-0 period exponential moving average EMA and the 5-0 period exponential moving average EMA. We use EMAs because they place more weight on recent price data, reducing the lag compared to simple moving averages. Next, before we trade any currency pair, we must analyze how that specific market reacts to crossovers historically. Every market has its own unique personality. Some currency pairs trend smoothly, while others are incredibly choppy. Look at this XAU 2-hour chart. If we look left, we can see that when the 20 EMA crossed below the 50 EMA, the price immediately reversed and went up instead. It did this multiple times. This pair has a history of generating false crossovers. If a market has a history of bad crossover reactions, we simply do not trade it. Instead, we look for a market that respects the crossover. Look at this XAU $1 chart. Historically, whenever the 20 EMA crosses the 50 EMA, the price immediately follows the direction of the crossover and starts a powerful, sustained trend. This historical alignment is your filter. By only trading markets that have a proven track record of respecting the moving averages, you instantly eliminate the majority of your losing trades. Part 3. Surgical exits using the ATR trailing stop. Once you have selected the right market and get your entry signal, how do you manage the trade? Most crossover systems tell you to wait for the moving averages to cross back in the opposite direction before you exit. This is a massive mistake. Because moving averages lag, waiting for a crossback means you will give back most or even all of your open profits before the exit signal is generated. Look at this example. You buy here on a bullish crossover. The price rallies beautifully, giving you a huge open profit. But then, the market starts to reverse. If you wait all the way until the 20 EMA crosses back below the 50 EMA to exit, you end up closing the trade near your entry point, wasting hundreds of pips. This is why we use a much better, non-lagging exit indicator, the ATR trailing stop loss. The average true range ATR measures market volatility. An ATR trailing stop places a dynamic line below your buy trade. As the price moves higher, this line automatically moves up with it, keeping a safe distance based on the current volatility. The moment the price reverses and breaks below this ATR line, you exit the trade immediately. As you can see, using the ATR trailing stop gets you out of the trade much earlier, protecting your hard-earned profits and keeping your pips intact. Part 4. The 200 EMA filter, the ultimate win rate booster. Now, let's discuss the ultimate way to use a moving average as a global trend filter. You can take almost any standard trading indicator, combine it with the 200 period exponential moving average, EMA, and instantly boost its win rate. The 200 EMA acts as the dividing line between a bull market and a bear market. It tells you the macro direction of the institutions. The rule is incredibly simple, yet highly powerful. Rule number 1. If price is above the 200 EMA, you only take buy signals from your indicator, and you completely ignore all sell signals. Rule number 2. If price is below the 200 EMA, you only take sell signals, and you completely ignore all buy signals. By doing this, you ensure that you are always trading in alignment with the major institutional flow. Let me give you a statistical proof. Let's look at the parabolic SAR indicator. If you trade the parabolic SAR blindly on the 1-hour chart, taking every single buy and sell signal, it has a backtested win rate of only 38%. This is a losing system. But look at what happens when we add the 200 EMA filter. By only buying when price is above the 200 EMA and only selling when price is below it, the win rate immediately jumps to 46%. Let's look at another famous indicator, the super trend. Trading the super trend alone gives you a win rate of 39%. However, when you add the 200 EMA filter, the win rate is boosted to 48%. This simple filter takes a losing, unprofitable retail indicator and transforms it into a highly profitable, institutional-grade strategy. Part 5. The 200 EMA in action, multiple case studies. Let's look at how we combine this in real time. On this XAU $1 hour chart, we have our orange 200 EMA on the screen. The price is trading firmly below the 200 EMA, meaning we are strictly in a sell-only environment. When our super trend indicator generates a buy signal, we do not take it. We ignore it completely. But when the super trend generates a sell signal, we execute our trade immediately. Look at how cleanly the market delivers. Because we are trading with the macro institutional flow, the sell trades move rapidly in our direction with almost zero drawdown. Now look at a buy scenario on this XAU. The price is trading above the 200 EMA. When the super trend generates a sell signal, we ignore it. When it generates a buy signal, we enter long. The trend continues upward cleanly, hitting our target with ease. The secret to consistent growth. I have just given you the absolute best moving average strategies that you can implement into your trading system right now. All I ask in return is for you to take 2 seconds of your time to like this video, subscribe to the channel, and hit the notification bell. It takes only 2 clicks, but it means the world to our team. Study these rules, practice them on your charts, and we will see you in our next trading masterclass. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. If your Elliott wave count keeps changing every time price moves against you, you're not reading the market, you're forcing the market to fit your bias. In this video, I'll show you how to identify clearer wave structures and avoid the mistakes that trap most traders. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. In the general picture, it is one of the principles, or what many people call a theory. This principle believes that the movement of the price in the stock market will have the shape of a swing. Swing, right? The shape will be like this. If you look at this picture, you will see the two properties of the swing. The first one is that it goes up and down. It's going up and down for a while, and it's going to repeat. It's not going up and down and then it's over. It's going up and down over and over again. It's going up and down over and over again. It's mainly caused by thoughts. It's caused